Ladies and gentlemen, good afternoon. I am Mitch Gomez, your MC and moderator for today's event. Please settle down as we begin our program. Kindly pause and bow our heads for a short prayer to be followed by the Philippine National Anthem. Our most merciful God, we come to you in our weakness. We come to you in our fear. We come to you with trust, for you alone are our hope. We place before you the disease present in our world. We turn to you in our time of need. Bring wisdom to doctors, give understanding to scientists, endow caregivers with compassion and generosity. Bring healing to those who are ill, protect those who are most at risk, give comfort to those who have lost a loved one. Welcome those who have died in your eternal home. Stabilize our communities, unite us in our compassion, remove all fear from our hearts, fill us with confidence in your care. Amen.
Mga kababayan, ang pambansang awit ng Pilipinas.
Thank you for participating in today's webinar on financial trouble, discussions on debt restructuring, financial rehabilitation, and insolvency. We are here right now, eyes glued to our screens, partly because of this man. He is the governor in charge of the MAP Corporate Governance Committee that made this webinar possible, and the lead independent director of SM Investments Corporation. Please welcome Mr. Alfredo Fred E. Pascual.
Thank you, Mitch. Fellow MAP members, friends, ladies and gentlemen, good afternoon. On behalf of the MAP Corporate Governance Committee, I would like to welcome you to this MAP webinar on financial trouble, discussions on debt restructuring, financial rehabilitation, and insolvency. This webinar is a part of this year's offerings of the MAP CEO Academy. Let me thank our immediate past president, Francis Lim, Ms. Ida Tiongson, and Attorney Cesar Villanueva for agreeing to share their knowledge and expertise with us today. Today's webinar was organized by the MAP Corporate Governance Committee for the MAP CEO Academy. The objective of the webinar is to provide MAP members and other business leaders with practical insights on debt restructuring and on the various options offered by the Financial Rehabilitation and Insolvency Act, otherwise known as FRIA. We're just too aware of the crippling effects of the COVID-19 pandemic on businesses. Hopefully, the learnings from today's webinar can help businesses in financial trouble to avert collapse, maximize asset values, survive, and eventually achieve recovery going forward. Our event today is the second webinar that the MAP Corporate Governance Committee is doing. The first one was on a new age of capitalism in the Philippines. It was held on March 16 and was organized by the MAP Management and Human Capital Development Committee. Our committee will be the one in charge of the July 13 MAP General Membership Meeting on the topic or theme, Governance Warriors, How Independent Directors Create Value. For 2021, our committee will also organize the following webinars. One, MAP webinar on data governance jointly with the MAP ICT committee. Two, MAP webinar on risks, the dark side of technology, jointly with the MAP ICT committee. And third, the MAP webinar on how the Great Reset may be pursued in both the public and the private governance sectors based on the lessons learned during the COVID-19 pandemic and the current administration. Please monitor your email and Viber inboxes for the details of our forthcoming webinars. Thank you one and all for joining this webinar today. Keep well and stay safe, everyone. Thank you.
Thank you, Fred. Some reminders before we proceed. As participants, you are automatically muted and your camera or video as well. Please submit your questions through the Q&A button that you see on your screen. You will only be able to see our speaker and reactor, and you will not be able to view the other participants. In case you lose connection, please join again by repeating the login details. And if it happens to me, please carry on, and I will do the same and catch up. We will have a Q&A portion after all three speakers have concluded. In line with MEP policy, we will dispense with a lengthy introduction of our speakers. We will just flash a slide on the profile highlights of his speaker and reactor. Many years ago, I listened to a speech from the late Senator Raul Roco to a group of bankers. I would like to share a brief story from his speech. Senator Raul Roco said, if you ask a banker what is 1 plus 1, his answer is 2. If you ask an accountant what is 1 plus 1, his answer is, what would you like it to be? But if you ask a lawyer what is 1 plus 1, his answer is, whose side are we on? There are multiple sides or stakeholders in the financial rehabilitation process. Is there a particular side whose interests are paramount? Or are all sides considered equitably, if that is even at all possible? Let us find out. What to do, what to do, what to do. Our first speaker will share her expertise and experience in the debt restructuring process. Please welcome the President and CEO of Opal Portfolio Investments, Inc., Ms. Imelda Ida C. Tiongson.
Thank you. Thank you, Mitch. And by the way, I'm not a lawyer. I'm the 1 plus 1. I'm more finance. So thank you, MAP. Thank you. Thank you, of course, the President, Gigi Montenola, our Governor in charge, Dr. Fred, Attorney Francis Lim, Dean Cesar, MAP members and guests. So my topic is more on the side of the debt restructuring. No, as I said, I'm not a lawyer, but I've been involved in the actual draft of the FRIA over 10 years ago, which was actually authored by Attorney Francis Lim. And since then, I've handled quite numerous FRIA cases, some as a debtor, on the debtor side, and some as wearing a hat as a creditor. So this specific session, my part, is I understand has been requested also by members considering the economic situation we're in. GDP has contracted record low of negative 9.5 last year, non-performing loans on the rise, temporary relief under the Borrow One, i.e. the business recovery, has already expired. More accounts are turning non-performing this year. Borrowers are expected to provide restructuring plans to the banks, hence this session. Whether it's an informal settlement, i.e. talking to your bankers, or through the courts, it's necessary for borrowers to submit restructuring plan or rehabilitation plan. And my segment will hopefully show you how to do this. So the aim is to really get you back on your feet. So my topic will encompass business health check, diagnostics, increase the chance with your creditors, and the other restructuring options that you may not be aware of. So here we go. We start with the business health check. Well, first and foremost, you need to check where your business is at. See, some businesses, even prior to the pandemic, were on the brink of closing anyway. So, and then during the pandemic, because of the change in market condition, some of the businesses really will not be able to survive at all. And they are on the terminal bucket. Can you file for you on that, or can you be restructured? Actually, the answer is yes, but it's more on the side of letting you pay the bank and sell down some assets. The other in the bucket list is temporary, which is because of the pandemic, people are not yet out, things have not normalized. Hence, those are the ones that are really looking for restructuring. And there are businesses that you can bucket as thriving, especially those ones that in a lot of the e-commerce, where there's a major shift from the brick and mortar to e-commerce, that would be thriving. So those are the stuff that you wish to bucket first. Do health check, and people would be asking, how do you actually do health check? Well, you have to cover 3 topics to do health check. Look at your historical finance, look at what you're doing in your operations and management, and find out what strategies must be put in place. So for the first one, which is the finance, where is your liquidity? Do you actually have some at the moment? Can you at least repay the interest? Now, I'm going to pause on that and tackle that in a little while. Maybe you do have some assets there somewhere that you may not be aware of. Some of your inventories can be sold down. Some of the capex can be sold down. I will tackle that. That could be converted to cash. Or it could be by way of external funding. It could be by your bank looking for an equity investor. And then on that side, you may need to take some time in asking the bank for you to help out, and hopefully you'd be able to find a buyer. On the operations side, look at your existing procedures. Is the model that you're in at the moment really workable? I mean, you could be a restaurant with amazing food, but it's not reaching the public. So you need to be online. So that's one of the change in model that you may need to think of. Digital transformation is so popular simply because the market has shifted more into that space. Do you have the right tools to help you survive? On the management side, there's the 4 R's you got to check out. You may need to reshuffle and restructure even the management. If not, if you don't have the right people from the board level to the employee level, you may need to reskill them or retool them. You may even need to retrain your own clients to be able to adapt where you're at. And of course, in most of the cases, which has happened last year and will continue to happen, is to reduce your operating expense by retrenching. Now, I always say this, you got to talk to your bankers first. Don't file under the FRIA or don't file legally. It would be best to talk to your bankers first. And then you're going to say, well, how do I do it? There are 4 questions that the bankers would need to ask you. And what do you need? When do you need it? Why do you need it? How can you repay? What do you need? You need to extend. At the moment, you can only pay so much. So can the bank extend your present loan arrangement? When do you need it? Well, you need it now. There could be an added working capital for you to be able to turn around. Why do you need it? Is for you to be able to eventually repay them starting low. How can you repay is the most crucial question of the bankers, simply because, of course, at the end of the day, they would want to get a repayment. So people may be wondering, well, what exactly are the bankers looking at in terms of detail? It's the typical 5 C's of credit: character, capacity, condition, capital, collateral. Now, I'm not going to go through this because this is going to take forever. This is going to take a whole session doing this. So I'm actually going to shift and mention more into the credit enhancements. And it's actually lining up with the 5 C's of credit. So first enhancement is in your rehab plan, in your restructuring plan, the banks would want to see if you have done good faith. Good faith, have you constantly communicating, making some sort of payments, offering some sort of collateral. In the capacity part, projected financials, that will be expected from you, where it will show when repayment will happen. Condition, market study, the market has changed. So how do you improve and capture the market? Is there actual demand for your product or service still, or is there a shift? For capital infusion, this is something that's a little bit tricky on the capital side, simply because a lot of the companies are having difficulty anyway. But there could be something like stockholders' loans can be converted to equity. And if there's none and you are strong in some of the credit enhancements, you have a better chance with your banks to be restructured. And I know banks are always mentioning this, and that's adding on collateral. Adding on collateral, and you're going to say, well, I don't have, you've got everything, or everything's encumbered. I don't really have anything. Please look at your balance sheet, look at your asset. There could be inventories, receivables, other unencumbered assets. You could have chattels. You can it's called ring fence. You can put them together and assign it to your bank. And in case you're able to liquefy it, then it's assignment by way of proceeds. So you'd be able to offer that at least as a collateral. For the restructuring tools, now that you know where you're heading at and you know when the funds are going to come in, you have a feel. But at the moment, it's quite tricky because fear is driving the economy, and we don't yet know when it will, as I said earlier, normalize. But there could be something that the banks can help you with, i.e., I'm talking about restructuring tools now. Example, move principal payments. So, for example, for school, they may be doing annual collection of tuition fees or half yearly. So instead of collecting monthly, that could be spread out into 2 repayment schedules only, either per annum or semi-annual. Alternatively, move principal repayments. It could be from a 2-year loan to, say, a 5-year loan. For argument's sake, 10 million loan on 2 years, it's going to cost you approximately 420 million in terms of principal repayments for 2 years. But if you spread it out in 5 years, it's about 167,000. So that would mean for you that you can request a longer term for you to be able to at least be comfortable in your repayment. Another restructuring tool is do it by way of installment. For argument's sake, you already have a due that it's already due December 2020, and you have turned non-performing. You may be able to request to, again, spread it out and pay it by installment. It could be, and by the way, there's a lot of different installment ways of doing it, and I'm going to expand that in a little while. Well, it could be that my cursor just disappeared. Okay. It could be partial payment. All right. You may have this is a live case. There's this property and the factory is just here. So what we told the client is, why don't you cut the property, sell this down, so you'd be able to make partial payment. So find out, think out of the box, be creative, because when you actually do partial payment, it gives the bank level of comfort and would be able to assist you in stretching the remainder of your debt. It could be by way of increasing payments. You know, it's pandemic now. So you want your 10 million to start quite low. So you want your principal payment to start only 500,000 and then creep it up to 1.5 million and then creep it up to 3 million and so on. So it could be by way of increasing by way of percentage or a fixed amount, depending on the projections that you have provided. It could be, and the banks may agree to this also, interest muna, no? Interest-only loan, where the principal payment will remain for the whole number of years, and you can at least cover the interest. The banks may be open to that. Typical of the banks, and this is a typical restructuring, it could be by way of capitalized interest. Basically, that means your principal and your unpaid interest, because of the borrow one, borrow two, they have accumulated. You can lump it up to a new restructured principal and then use some of the other restructuring tools I have previously mentioned. So these 6 examples that I just mentioned to you are just some of the examples of restructuring tools. The banks may be able to assist you, but you have to really sit down and talk to them. When you are going to be asked, and when you file under the FRIA anyway, or when you speak to the bank, they'll be requesting for you to submit your proposal. So we've mentioned a little while ago what should be included. Now this is a summary of what should be included. Your business plan, maybe their strategy would be changed, and how the changes that you're going to do in terms of the FOM, Finance, Operation, and Management. Credit enhancements, I just mentioned that, the 5 C's of credit. What other things you can offer to give the banks a level of comfort. Financial projections is an absolute must for the banks to have a feel on a repayment plan. Of course, you have to provide also market study based on whatever is happening now, and the possibility when you can stand on your feet, market study on prospects. So that would be a backing as far as the banks in terms of finding out what is the market condition, particularly in your industry. Please do not forget that it's not all financials. What areas in your operations and in management you may need to address. Process improvement is an absolute must to be included also in your rehab plan. So yeah, I went through that fairly quickly. And my point is, having that it could possibly give you a better chance with your creditors' approval and off your road to recovery. But again, if you feel strongly that you are not seeing eye to eye with your creditors, and you strongly believe you may have that chance to survive and maybe eventually thrive, there is a law, and that's a debt relief. It's just ahead. And this is called the FRIA, Financial Rehabilitation and Insolvency Act. Strengthening the business is needed today. And the reason for that is, if we strengthen the businesses are the engines of the economy. That will have a domino effect in the strength of the bank or the banks, and of course, the Philippine economy. That ends my presentation, and thank you. Over to you, Mitch.
Thank you, Ida. You have given us quite a number of helpful tools, and I'm sure we will get a lot of questions later on. Our next speaker will walk us through the basic concepts and procedures on financial rehabilitation. And who better to do that than a major contributor or author of the FRIA law. Please welcome the Senior Legal Counsel of Accra Law and the immediate past President of MAP, Attorney Francisco Francis Lim.
Okay, thank you very much, Mitch. Okay, Ida mentioned the Financial Rehabilitation and Insolvency Act, and I was asked to do a quick summary of this law. I have to warn you that I've been lecturing on this law, and it usually takes me 2 hours, but I think I have only about 20 minutes to do it. So what I'm going to do is just to give you the basic concept, no, in order to help you take advantage of the law. If you decide to do that, you have to know what you expect under the law in terms of your obligations, in terms of your responsibilities, in terms of the benefits that will accrue to you and your company. First of all, next please, next slide please. Hello. The legal framework is under the Financial Rehabilitation and Insolvency Act. That was, I think, enacted by Congress immediately before the turn of the, I think it was in 2009. This new law repeals the 1909 Insolvency Act. It took us 12 years to put this law into place because it was not a very popular piece of legislation. So we had to push hard in Congress in order to just replace our Insolvency Act, which was turning out to be not responsive to the needs of the time then. Unfortunately, the law is now here. There is this pandemic, and I do believe that this new law, one of the most advanced laws in rehabilitation in the whole world, will help respond will help respond to the pandemic. Now, subsequent to the law, there is the rules of procedure on financial rehabilitation put in place by the Supreme Court to implement the law. So next please. Okay, there are 3 modes of rehabilitation. But before I go to the modes of rehabilitation, what is rehabilitation? Rehabilitation is effectively a remedy that is available under this new law to put your business back to business before it suffered to the same financial condition before it suffered from liquidity problems. Okay, and there are 3 modes authorized by the law. It's called the first one is called court supervised rehabilitation, renegotiated rehabilitation, and the third one is the out-of-court or informal restructuring. I will give you the basics of each of these kinds of rehabilitation. But before going that, next please, next slide please. I'd like to let you know what are the general matters of provisions governing all these 3 types of rehabilitation. Next. Okay, one thing to note is that rehabilitation proceedings are binding on the whole world, regardless of whether the creditors or the third parties like you and me participate in the proceedings. So whatever the decision of the rehabilitation court will bind all of us, even if we did not participate in the proceedings. And that is the reason for that is that, as Ida said, businesses are the engines of the economy, and therefore there's a need for certainty. Once the rehabilitation court decides, or the creditors and the debtor decide on adopting a plan on to help the business recover, that plan should bind everybody. Okay, next. Okay, who are entitled to next please? Who are entitled to rehabilitation? Okay, what is necessary is that the petitioning debtor should be an insolvent debtor. If you're a financially healthy creditor debtor, you cannot opt for to file for rehabilitation under this law. But what is insolvency? Insolvency it's either your assets are less than your liabilities, or even if your assets are more than your liabilities, if you foresee the possibility of paying your debts as they fall due, then you're entitled to rehabilitation under this law. That's one basic concept. Okay. The other one, next, please. Go ahead. Next slide. I'm sorry, I could not share my screen here, so I instructed the staff to share screen. Okay. Now, the big question of businesses is what happens to their business while the company is undergoing rehabilitation? For example, will management be replaced? Will the board of directors be replaced? The answer is no, because this law adopts the debtor in possession principle or rule, meaning to say that both the board of directors and management will continue to manage the business, of course. But in certain circumstances, next please, there are exceptions. For example, management may be taken away from the board of directors or from the incumbent management if there's actual or imminent danger of dissipation, loss, wastage, or destruction of the debtor's assets because of their negligence, or there's paralyzation of the business operations. So those are the three. There are three instances actually, but I'll just emphasize these two. Next, please. So what is a rehabilitation plan? I think Ida has mentioned this. When you file a rehabilitation proceeding or petition, it's not just a matter of filing the petition. You have to attach to your petition a rehabilitation plan. And the rehabilitation plan is defined by the law. Is that it's like a business plan, no? Where you will tell the court, where you will tell your creditors and the whole world how to make your how your company can recover from its present financial difficulties. And some of these things have been mentioned by Ida, like debt forgiveness. You can ask a creditor, for example, to forgive part of the interest and the penalties. Debt rescheduling, meaning to say you have to you can ask your creditors to extend the terms of payment. You can reorganize your company, even change your management if some of your people are not performing. You can, for example, if there are available properties, you can offer those properties to pay off some of your debts in order to lower your interest payments. We have also a debt to equity conversion. For example, if you have an investor interested, no, in helping you let your business recover, he can lend money to you and eventually make an arrangement that that money that is lent to you can be converted into equity. You can even sell a part of your business. For example, if it's a multi-business company, you can sell the non-performing parts of parts of your businesses that are losing. And you can even set up a new business entity where the more profitable businesses or business divisions can be transferred to. So these are the types of plans of things by which you can help rehabilitate your business. You see, a rehabilitation plan is very important. But the question is mere submission of the rehabilitation plan enough? No. The rehabilitation plan must be voted upon by the creditors. Okay? And how is voting required? It's not on the per capita. For example, the law says a majority of the creditors should approve the plan. If you have 5 creditors, is it enough that the 6 of the 10 creditors, let's say 10 creditors, is it enough that 6 of the 10 creditors approve the plan? No. Those 6 creditors must hold a majority of the company of the company's liability. Next, please. This is what I'm doing. Okay, next slide. Okay, another key person aside from the court is the Rehabilitation Receiver. This is the one that will review the rehabilitation plan submitted by the petitioning company. Okay, and after reviewing it, the Rehabilitation Receiver submits the plan to the court for its approval. In court supervised rehabilitation, the role of the Rehabilitation Receiver is key. For example, the company and the rehabilitation cannot make payments unless it's approved by the Rehabilitation Receiver. The court will not approve the rehabilitation plan unless it is recommended for approval by the Rehabilitation Receiver. The company cannot sell any of its properties or own any of its properties unless it is approved by the Rehabilitation Receiver. Next, please. Next. Next. Okay. I think our FRIA is the only insolvency law in the world that has taxation incentives. The law says that upon issuance of the commencement order by the court, and until the approval of the rehabilitation plan or the dismissal of the petition, whichever is earlier, the imposition of all taxes and fees, including penalties, interest, charges due to the national or local government units shall be considered waived. So this is a lot of those who have petitioned for rehabilitation have availed of this particular tax incentive under the FRIA. It's for example, the company under rehabilitation is exempt from income tax. It's exempt from the payment of real estate property taxes. Any penalties that for unpaid taxes will stop to run upon filing of the petition until the rehabilitation plan is approved by the court. This is a very powerful tool to help our companies get rehabilitated. Okay. But let's now go to court supervised rehabilitation. Okay, I will not discuss the details of this. What is to be remembered is that court supervised rehabilitation are court driven. Almost everything is determined by the court. For example, whether the petition is sufficient in form and substance, whether the petition should be given due course, whether the rehabilitation plan should be approved, whether or not the rehabilitation proceedings should be converted into rehabilitation. And all of these things, I have to repeat, will need the recommendation of the Rehabilitation Receiver. Next, please. Let's now go to the pre-negotiated rehabilitation, because I was given only 10 minutes. No? Next, please. Next. Pre-negotiated, that slide. I think it's slide 34. Okay, stop there. Now, what is the effect of filing rehabilitation on existing contracts between the company and its counterparties? Okay, this is a very new provision. Basically, it says that existing contracts will continue to be forced and effect, but the company or the debtor is given 90 days to confirm whether existing contracts should continue. If within the 90-day period the debtor does not confirm the contract, then the contract is deemed terminated. That's very, very important. For example, it may be that you're leasing a lot of properties and some of those leases are no longer necessary or are detrimental to having your company rehabilitated. Then you as a debtor can manifest to the court that you don't need that contract. Okay? If you don't do that, then the contract is deemed terminated after the expiration of the 90-day period. Let's now go to the slide before that, slide 35. Okay. What is the difference between a court-supervised rehabilitation and pre-negotiated rehabilitation under the law? In a court-supervised rehabilitation, all that you need is the approval of a majority of the debtors holding more than 50% of the liabilities of the company. In a pre-negotiated rehabilitation, what you need is 2/3 creditor approval. Okay, but another difference is that the court has 1 year to approve a court-supervised rehabilitation. In a pre-negotiated rehabilitation, because the level of approval is much higher, then the court is given only 100 days, 20 days to approve or disapprove the plan. What happens, no? And the objection by the creditors is very limited. What happens if the court does not approve the plan within the 130-day period? Please go to slide 37. Okay, here it is. In a pre-negotiated rehabilitation, which has a higher creditor approval requirement, the maximum period for the court to approve the plan is 130 days. If the court fails to act within that period, the rehabilitation plan shall be deemed approved. And the approval of the rehabilitation plan shall have the same effect as confirmation of a court-supervised plan. What does that mean? Under the law, if the court confirms a court-supervised rehabilitation plan, its provisions are binding against the whole world. It's if that the provisions are even binding against creditors who objected to the plan or who did not participate in the drawing of the plan. That is what is called cram down under the rehabilitation law. Okay. Can you go to slide 38? Okay, and 39. The third kind of rehabilitation under the FRIA is what is called out-of-court restructuring. I think this is a possibility for a debtor who is able to get at least 85, the approval of its creditors representing at least 85% of its total liabilities. I've handled a case where the debtor was able to get 85% of the total liabilities creditor approval, and the company, the debtor, was able to avail of this. Now, what is the advantage of this? Okay, the advantage of this is that once you get the 85% creditor approval, you don't even have to go to court for court approval. It's next, please. Can you go to the next slide? Okay. It's self-executing, so to speak. All that you need to do is to publish in a newspaper that your rehabilitation or restructuring plan is approved by the required number of creditors, 85% creditor approval, and that the law considers it to be automatically binding on the whole world, including creditors who failed to vote or who objected against the 15% creditors who objected against the rehabilitation plan. Now, prior to a restructuring rehabilitation plan, under this law or under this provision of the law, the law and the rules say that the debtor who wants to negotiate an out-of-court rehabilitation can get a standstill period, meaning to say a period where creditors are prohibited to take enforcement actions against the debtor, provided that it gets the approval of more of creditors representing more than 50% of the total liabilities. So it's like a suspension order in a court-supervised proceeding. It's like a suspension order in a pre-negotiated rehabilitation. But the difference is that in those two instances, you need a court order. But in this kind of rehabilitation out of court restructuring, once you get the 50% agreement of creditors representing 50%, more than 50% of the total liabilities, the standstill period automatically kicks in. And during that period, I think there's I think for 120 days, no creditor can file a collection case against you, can ask for an offsetting of your bank account. And the reason for that is to give the parties, both the debtor and its creditors, period to negotiate an out-of-court restructuring. So I think that's all. As I said, these are just very basic. No? And if you want to have more detailed information about this, just let me know. Thank you very much.
Thank you, Francis. We will surely get back to you during the Q&A. Reactions. For his thoughtful insights, please welcome the founding partner of Villanueva, Gabionza, and D Law Offices and the chair of the MAP Corporate Governance Committee, Attorney Cesar L. Villanueva.
Thank you, Mitch, and good afternoon, everyone. In his inaugural address, MAP President Gigi Montenola discussed the 5 severe crises facing our nation: the health crisis, the economic crisis, the environmental crisis, the education crisis, and the combination of all such crises bring about inevitably our social justice crisis. With the rollout of the vaccines in our country, we are beginning to see the light at the end of the tunnel for the health crisis that is plaguing us. And yes, we see that the tunnel has yet a long way to go for us Filipinos. But we know, with a deep sense of both hope and despair, that every day takes us closer to the light. With the health crisis inching towards solution, the clear challenge that faces us now on both the macro and micro levels is the weathering of the economic crisis. Although year 2020 has seen our national economy suffering its worst drop in GDP and one of the highest unemployment rates, there is hardly any doubt that eventually our nation as a whole will survive such financial onslaught. And perhaps rising from the ashes would be a national economy that would be more vibrant, sustainable, and hopefully more inclusive. It is therefore in the micro level that the economic crisis would do its most lasting injury to many Filipinos of every walks of life. There have been business, especially MSMEs, that have vanished from the scene and are never coming back, in spite of the moratoriums granted under Bayanihan Act 1 and Bayanihan Act 2. And now, with the lapse of the moratorium periods, we shall be seeing many big and small businesses succumbing to the financial distress they are facing and vanishing from the economic scene. This is an inevitable result of going through one of the worst recessions in our history. Already, we are beginning to see this unfolding in the aggressive debt management programs being undertaken by significant companies in our country, which are shedding of valuable assets to overcome the unbearable debt burdens. In a few months, we should expect significant companies commencing rehabilitation proceedings, if not insolvency pursuits. There is also no doubt that this economic crisis will bring about big winners, firms which and businessmen who will be gobbling up other businesses whose business models still very much viable, but which are just too leveraged. Great and small fortunes will be lost by many, and even greater fortunes will be gained by a few. As MOP President Montinola assessed in his inaugural address, just staying alive may be the best option to most firms and small businesses for this year and perhaps for the next 3 years to come. The forum this afternoon focuses therefore on the theme, how does a businessman, or for that matter, a family, stay financially alive or remain a going concern until there is a turnaround in our economy? We certainly should thank Edith Tiongson for her very instructive and at the same time very practical approaches that borrowers may pursue with their creditors on how to structure their debts. We certainly can take Ida at her words, since rehabilitation and turnaround of businesses has always been her forte. Frankly, however, when debtors and borrowers are at the end of their financial ropes and are just trying to get a reprieve from their bankers and lenders, they are often met by a Shylock who will not even consider discussing a time off from foreclosing without the borrower first putting in more collaterals for their already over-collateralized loans. This is a sign of good faith on the part of the borrower. More often than not, the attempt at debt restructuring would have caused the harangued borrowers more losses of properties otherwise shielded from the lender's lien had such borrower not begun the restructuring talks in the first place. That is why we appreciate the presentation given to us by Attorney Francis Lim, the immediate past president of MAP and the current president of Phoenix, who discussed the various options available under FRIA. Most bankers and lenders do not have a favorable view of FRIA on the ground that it is too borrower-friendly. I dare say that on that score, the FRIA is where it should be. FRIA represents what I would term financial social legislation towards protecting the interest of many stakeholders to the business enterprise, not just the shareholders, but likewise the employees, the suppliers, and the public that partakes of the products and services and support of a company which is experiencing a financial distress. Bankers and lenders do not need extra protection from their borrowers. For the legal system, with its structure of liens, mortgages, and other credit securities, provide formidable offensive weapons, aside from the fact that they always have the best legal representation in any of the issues. In fact, the state has recognized the pivotal role that the banking system plays in our society, so much so that in financial crisis, it has extended generous helping hand to banking institutions through the Special Purpose Vehicle Act from the effects of the Asian financial crisis, and now the Financial Institution Strategic Transfer Act, or FIST Act, for our present COVID-19 crisis. Now the bankers and their lawyers can well protect themselves. So debt restructuring becomes therefore an uneven bargaining situation. FRIA therefore is the state's protective arm by which the various stakeholders of the borrowing companies are allowed a breathing space within which to come out with a viable rehabilitation plan. And failing to do so, a system of liquidation and insolvency is pursued through an orderly court process. The built-in moratorium system under FRIA, which is the stay order, which is when the stay order is issued by the court, is a very effective mechanism by which debtors and their creditors collectively and realistically resolve and adjust competing claims and property rights. And that when it is shown within the limited window provided in the law that the business is not rehabilitable, then FRIA facilitates a speedy and orderly liquidation of debtors' assets and settlement of obligation. As the Supreme Court has often held in many of its decisions, the rationale of rehabilitation is to effect a feasible and visible and viable rehabilitation by preserving a floundering business as a going concern, because the assets of a business are often more valuable when so maintained than they would if liquidated. Nonetheless, what I think is wrong with FRIA, and this is with all excuse to Attorney Francis Lee, is that it is really anti-poor, or more properly, it is anti-MSME. FRIA covers a whole system that is really intricate and expensive for the average businessman to avail of, from the retainer engagement of legal counsel, who must not only well versed in the intricacies of FRIA, like our speaker, Attorney Lim, compensation due to the receiver, and often the additional investment that is demanded from the shareholders to make the business rehabilitable. For businesses pursued through corporate medium, perhaps sometimes it's better to just let the company assets go to the banks and other creditors, and the owners availing themselves of the limited liability features of the corporate vehicle, and using whatever remaining assets that they have not invested into the business, or which they would not have committed into the rehabilitation plan, to start again in life. Unfortunately, time and again, most businessmen are truly sentimental of the companies they built through the years and pursue their belief that somehow, sometime, if the banks can be put at bay for a while, they could recover their former glory. This is a belief that will prevail in most settings during the pandemic and its aftermath. A belief that the vaccines that will cure us of COVID-19 would also eventually cure struggling and insolvent business from the inevitable financial end. Therefore, the lessons on health check alluded to us by Ida. Finally, for individual debtors, or more properly, businessmen who pursue their business through the sole proprietorship, the individual insolvency proceedings provided for under FRIA would not only be a costly endeavor, but it really does not bring a fresh start in their business life. Unlike the old Insolvency Act, Act number 1956, which provided for a discharge to an individual debtor who has voluntarily filed an insolvency petition that allowed such a debtor a clean slate from his old debts and liabilities proven during trial, and thereby giving the businessman a fresh beginning to a new business pursuit. the FRIA does not contain a discharge provision. Although Section 103 of FRIA provides that an individual debtor whose properties are not sufficient to cover his liabilities and owing debts not exceeding $500,000, and I quote, may apply to be discharged from his debts and liabilities by filing a verified petition, attaching to his petition a schedule with debts and liabilities and an inventory of assets, end quote. There is no provision in the FRIA that provides for the same discharge effect found in sections 64 to 69 of the old Insolvency Act, which allowed an individual debtor to formally ask from the insolvency court for a discharge from all his debts, and that when the court grants a discharge, the effect is, and I quote, to release the debtor from all his claims, debts, and liabilities and demands that may have been set forth in the schedule, or which were or might have been proved against his estate in insolvency, and may be pleaded by a simple averment that on the date of its such discharge was granted to him, setting forth the same in full. And it says, the same shall be a complete bar to all suits brought on any such debts, claims, liabilities, or demand. And the certificate that shall be prima facie evidence in favor of such fact and the regularity of such discharge, end of quote. So going through the process of insolvency under FRIA, the small guy, the individual debtor, the small businessman finds that he remains liable for all the debts unpaid and sought to be settled under the insolvency proceedings that just ended. So what's the point of an individual debtor spending time and money for a FRIA insolvency proceeding? I believe that it is in this aspect that the FRIA is a step backward from the provisions of the old Insolvency Act, and is one of the items where the small guy, the small businessman, doesn't really get the reprieve that he wants. Thank you for listening, and again, good afternoon. Back to you, Mitch.
Thank you, Cesar. I was rapt listening to you. We've heard business sentimentality, Shylock thrown in, and shortcomings of the FRIA law. We move towards the discussion phase of our webinar, and we will be having a Q&A. For our attendees, please submit your questions to the Q&A button. Due to time constraints, our participants will not be given the opportunity to speak. Let me start off. Perhaps Francis and Ida, you can answer this. It took 100 years to amend the old insolvency law. FRIA has been now the law of the land for the last 10 years. What has our experience been, or what has your experience been in terms of being involved in the rehabilitation process under FRIA? Ladies first, Ida.
Okay. I'm going to mention this in terms of wearing a hat as a creditor. So I find on the creditor side that it's easier to get the client or the borrower withdrawing out of the FRIA, or you winning as a creditor, if you can find something like an error in the form and substance. For argument's sake, they don't have secretary certificate. For argument's sake, they are both insolvent and no cash flow, and they cannot prove that. It's actually easier to pull them out. So I find that those are the quicker ones. However, the ones that are what I call bona fide rehabilitation, it has taken quite a long time. And at the end of the day, you really end up talking between the creditors and the borrowers, talking and then agreeing on something. And that's something that we actually like, that part, because when creditors and debtors, if you both agree, you can submit it. And because it's under the pre-negotiated arrangement, so the court will have to approve it within 120 days. So it's actually faster. And in addition to that, if you have, let's say, a couple of creditors that are not agreeing to it, lack of a better word, you can cram them down and follow the rehabilitation because majority of the creditors have already approved. So I like that part. Now on the liquidation part, it does take a long, long time. I don't even want to mention years, but really long time. So, and that's because it's kind of in and out, and you will have a lot of voice, being gathered, and hopefully at the end of the day, you will find some middle ground how to do the proper liquidation. So, yeah, I'm not so happy on the liquidation side, but certainly major parts of the FRIA, and again, I'm saying wearing a creditor hat.
Thank you, Ida. Francis, your comments on how, are there any success stories arising out of the FRIA rehabilitation process?
Definitely, Mitch. No, this is anecdotal. No? Before the FRIA, before the rules on corporate recovery issued by the SEC, which was a set of rules that were in place because our old Insolvency Act was 1909 vintage. No? There was nothing there on rehabilitation. As a young lawyer, I vividly recall the Philippine Grooming Bills case. Remember that? I don't know if you're already born. No? It was, I think, the first or one of the first steel milling companies in Asia. Okay? It could have been a very big company. It underwent, it suffered some financial problems. Unfortunately, at the time, I do recall, I just got married, I think, 1981 to 84. The case was filed with the SEC in an effort to get itself rehabilitated. Unfortunately, there were no rules. All that the SEC charter provided is that the SEC has the power to over suspension of payments. And because there were no set of rules, okay, it took at least, if I recall it correctly, more than 10 years, I think as long as 15 years for the case to be pending before the SEC. And what was the result? The company went kaput. No? It was not able to recover, and one of the first, if not one of the first, steel milling companies in Asia have just disappeared only because our Insolvency Act then was not responsive to the needs of that time. I think you remember the 1980s, especially after the Aquino assassination. Okay, and there are other, for example, the Stanford Microsystems Inc. That's another case. It's one of the first companies on microelectronics, no? And again, because of a lack of a law, because of an outdated law under the 1909 chapter, it just died, no? A natural death. And that's why, as a young lawyer, I really did believe that engines, the businesses are engines of the economy. Remember, there were a lot of displaced workers, both the PBM and Stanford Microsystems in case. There were a lot of workers who lost their job. And that's the reason why we worked hard for 12 years, because nobody really understood what insolvency law was. No? Even among our congressmen, we worked hard. Unfortunately, in the early 200s, this law was put in place. No? And there are a lot of provisions that I like in the law. First, for example, the court is given only 1 year to decide in case of a court-supervised rehabilitation. Number two, in case of pre-negotiated rehabilitation, as Ida said, it's a maximum period of 120 days. Otherwise, the plan that has been pre-approved by the debtor and the creditors holding at least 67% of total liabilities will be deemed approved. And more than that, there is this out-of-court rehabilitation where you don't even have to go to court for approval. It's self-executing, so to speak. No? And we're counsel to a lot of clients, corporates. No? For example, the Hanjin case, no? We're counsel for one of the creditor banks there, and we have seen it work. No? I was counsel to one company that underwent first court-supervised rehabilitation, liquidation, then pre-negotiated rehabilitation, then out-of-court rehabilitation, in a way, it was able to recover. I don't know what's happening now, but it's because we're done with it. So there are good experiences. No? On Dean Villanueva's point on FRIA being anti-poor, anti-SME, I think that's one improvement of the law. This rehabilitation by single proprietorships, by individuals, okay, doing business under single proprietorship, I have to admit, was a very late addition of the bill. I think when the bill was already being finalized, the BSP just said, why don't we include single proprietorships? And that's the history of that provision. But I think Congress did not have time to come up with a separate title or a chapter of this law that was that should be tailor-fitted or custom-fitted to the needs of the SMEs or the medium-sized businesses. I know that it's as expensive as a petition for rehabilitation filed by the big corporates, no? And therefore there's that disincentive for the MSMEs to avail of this law. But I think the rules of procedure promulgated by the Supreme Court have some provisions along the line. On the, I'm just addressing what Dean Villanueva said, no? Before I forget, no? Because many things are running by my mind. On the lack of discharge, Dean Villanueva, you cited, I think, Section 103, no? But in addition to Section 103, I think there's Section 69 of the FRIA, which basically says that any compromises or on amounts or rescheduling or timing of payments shall be binding on all creditors. Okay, meaning to say that even if I think there's another section not limited to Section 69, even if there is failure of the rehabilitation plan, once the plan is approved by the court, and if the implementation fails, no, then whatever is contained in the plan will forever be binding upon the debtor and the creditor. So in a sense, that constitutes a partial discharge for the debtor at issue. So we've been discussing that. There's that discharge under 103, but there is also that form of partial discharge under this under the other provisions of the FRIA that will have the same effect as the discharge under the old insolvency law.
Thank you. We have a couple of questions from our Q&A box. Let me refer to them. Question number 1, do BSP regulations now allow capitalization of unpaid interest in a restructured loan? This was previously prohibited by the BSP. Anyone care to?
I could
yes,
answer
Ida?
that one. Yes. Capitalization of interest is a standard restructuring tool of the banks. I'm not certain where the comment on the not or being prohibited. There's two types of unpaid interest. One is the accrued interest and one is the non-accrued interest. So I would suppose it's the non-accrued interest that you're able to capitalize. Let me put numbers into this. You have a 10 million loan end December, end of the borrow 2. Then you have an unpaid 1 million that you're not supposed, that you were allowed not to pay under the borrow 1 and borrow 2. So those have been accumulated. What you can do is to include the unpaid, unaccrued, and that will form part of the new principle. That is actually negative to negative. I'm going to say not allowed, but actually allowed. And most banks, if not all, are actually doing that type of restructuring.
Thank you, Ida. Another question from our chat box. I will ask Cesar to field this. From the perspective of the creditors, what different best strategies do they have available to recover their capital in a distressed situation?
Oh, well, they have basically the law on credit securities at their behest. For example, the foreclosure of mortgages, they're working out through restructuring to ensure that no matter what happens with the pursuit of restructuring, they are in a better position to be able to recover as much from the debt. Those are the various things that they can. In other words, the ability of banks to be able to recover in times of financial distress is actually built into all of the financial instruments that they ask borrowers to sign, be it a real estate mortgage, acceleration clause, and things like that. And all within the great framework, what we call mutuality and the binding obligatory force of the contracts that they issue with the creditors. It is this sanctity of the enforceability of the contractual terms that in fact the FRIA seeks to put a break and therefore allow the borrowers sufficient time to be able to defend themselves, so to speak, and defend the going concerns of their business against what is the formidable weapons in the arsenal of banks and other financial institutions.
Thank you. Our next,
That Mitch,
Ma-
may I add
yes,
that?
Francis, go ahead.
Okay, Dean Villanueva is correct, no? The law is expressed that the right of the banks or the creditors, which include the banks, no, to enforce their secured liens cannot be diluted, no, or diminished by a rehabilitation plan. For example, if let's say creditor bank A has a mortgage over the plan, okay, the rehabilitation plan cannot say that the bank, the creditor has to give up that mortgage, because the sanctity of mortgage is respected by the FRIA. Okay, so that in the event of a failure of rehabilitation, even if the bank votes in favor of the rehabilitation, for example, by extending the terms of payment, by waiving part of the interest, by waiving part of the penalties, the bank has still that security if at the end of the day, despite the concessions given by the rehabilitation plan, despite the concessions given by the court, despite the concession given by the other creditors, the rehabilitation plan is not successfully implemented, that at that point, at the point of liquidation, the bank can still enforce its security over that plan, manufacturing plan. Okay, so okay, and that's one way of the bank, no? One way the bank can recover its capital, no, its loan from the company under rehabilitation, because the enforcement of the mortgage lien is not diluted or diminished by the rehabilitation plan.
Thank you. Francis, we have another question at the
Sorry,
Q&A box. Yes, Ida, please.
Yeah, I want to add a couple more under the FRIA. There is a creditor-initiated rehab. So if the creditors feel strongly that they have a better rehabilitation plan, that can be filed. It's not normally used. And if I may add on what's positive on the creditor's point of view, ordinarily, if you're actually fighting in an ordinary court, they would have possession of the property. Under the FRIA, there is preservation of assets as well. So that's a little bit level of comfort, because the receiver, one of the receiver's duties to ensure that the assets are preserved, which is actually your mortgage. So that's good for the creditors.
Yeah,
All
in
right.
fact, Mitch, if the debtor does not preserve the asset, okay, there is a provision in the law that the creditor holding security over that asset can ask for the modification of the stay order so as to enable that particular creditor to foreclose on the mortgage. That's one provision there. So that, for example, if the debtor does not take insurance to protect the manufacturing plan, in my example, the bank debtor, creditor who holds mortgage on the property can tell the court, well, I want to foreclose the mortgage because it's risky. The debtor is not taking insurance, no, or has not renewed its insurance of the building, and if the building it burns, then that is prejudicial to my interest as a secured creditor for that particular asset. So what we did in the insolvency FRIA is to balance the interest of both the creditors and the debtors. I take issue to the I really fought hard, no, as a lawyer, to try to strike a balance, no, between the rights of the creditors and the rights of the debtor, because at that before this FRIA, it was really at least the perception then was it was debtor friendly at the expense of the banks, no.
All right. Francis, this is directed to you. The question is, would the standard clause in a mortgage contract that filing for rehab is an event of default bar a petition for rehab?
The
I'm
answer is
reading it.
no.
No.
The answer
All
is
right.
no.
All right. Okay.
Well, when you standard clause is that if you file for insolvency, that's an event of default. But that standard provision does not prevent the borrower company or the borrower business from resorting to rehabilitation under the FRIA.
All right. Cesar, this is for you. Um, I'm looking at my list of questions here. There. What are the kindest comments you hear about FRIA from banks, if any?
Oh, one of them is that it allowed basically a clear framework by which to pursue rehabilitation. Prior to FRIA, the rehabilitation powers were found in Presidential Decree
902.
902-A. And it was just a one phrase thing under Section 5 of PD 902-A. And eventually, both the SEC and the Supreme Court had to develop the doctrines and jurisprudence behind those, like equality among the debtors and things like that, and the effects of the stay order. The FRIA, therefore, represents what we call a systematic and structural representation of how the author thereof, Attorney Francis Lim, has been able to systematize them that tries to balance. Otherwise, it was a difficult way to go through it, right? And people were not sure of the outcome. Here, they are sure of the outcome, and the limited period provided for by which to determine the rehabilitability of a debtor is quite sure. It does not put bankers and lenders at such a great time trying to sort through how the courts do it. That's one thing that the FRIA did. In addition, FRIA has been able to provide a framework by which the Supreme Court has been authorized to assign specialized RTC special commercial courts, judges who are learned in this technical aspect of insolvency and rehabilitation to be the ones to take them. They have become commercial courts, one of the fulcrum by which commercial courts have been constituted, so that you have in the entire archipelago a system of courts of general jurisdiction, but whose judges basically are well learned in commercial aspects of FRIA. Otherwise, it was a whole civil law system that we had in the RTC. That's one of the great changes that the FRIA law has given to our commercial landscape.
Thank you. Ida, this is for you. Cesar mentioned about sometimes the sentimentality of businesses and families perhaps clouding their judgment, right? So in your experience, Ida, when businesses go into the FRIA restructuring or in bilateral negotiations with their creditors, what are the proper expectations coming into this process from
Well,
the debtor side?
on debtor's point of view, the expectation of the debtors sometimes does not match the policies of the banks. No, so on the debtor or debtor's point of view, they would wish to continue using their line. On a debtor's point of view, they would wish the bank not to collect for a long time. So there are things that kind of close to impossible in terms of the request. So you got to work with your creditors, because the creditor's point of view would be, when can you repay? So it's not just, okay, we'll allow you not to pay, but what can you offer? So on your side as a debtor, you got to be prepared in case you have certain requests. My request is I don't want to pay yet because I'm looking for a buyer on my property. I don't want to pay yet because I'm looking for an investor. And this is where what can be requested would be an extended time. It could be principal and interest. We call it bullet payments. And request the bank for that particular moment. But the banks will give that to you in highly exceptional cases, that there's good faith that you are indeed trying to sell the company or sell the property, and not too long a period. So the expectations actually would depend on the debtor's point of view, where they can see light at the end of the tunnel and not to be stopped yet. What the debtors are worried now is more on this pandemic. They're going to say, well, you know what? As soon as there's vaccine and everyone's get vaccinated, we're gonna be back to normal. So my motel, my hotel, my restaurant will be up and running again. So you want your expectation is for the banks to agree with that period, but you're unable to actually offer a restructuring plan. So that's the tricky part of it.
All right. Question for all three. Again, within the rehabilitation restructuring framework, in athletic equipment makers, sometimes they have this motto of no pain, no gain. No, does this apply as well, both to the creditors and debtors? Ida, you have the floor.
Yeah, I do have the floor again. Okay.
Yes,
Yeah, I
and then
call
we
it
move
share.
to.
Yeah, share the pain concept. The debtors would ask full waiver of penalties, full waiver of interest, or that's close to impossible. At least reduce the interest and what have you. So the creditors are being asked to give up. So what about the side of the debtors? Could you add collateral? And you're going to say, I know, Attorney Cesar's going to say that is so standard. But adding collateral, if not that, what can you offer as credit enhancement? And by the way, that's under the 855 BSP circular, that there's going to be credit enhancement. So what credit enhancement can you offer? So how can you show good faith? That's why I said in the absence of anything, look at your balance sheet and maybe you can do a ring fence concept. So yeah. So yeah, I could go on and on in terms of giving you samples for this, but I'd give the floor to the other two gentlemen.
Cesar, your concept of no pain, no gain under restructuring or rehabilitation?
Under restructuring and rehabilitation, that concept is free because we're in a situation where there's no much pain going around. Even for banks, why would they want their clients and borrowers to be going into insolvency, right, or lockdown? They don't even want them to default because they do make more money in the long term by having their clients healthy. So it's what Ida says. You share the pain around in order to achieve a better result than just trying to foreclose on the loans. And that's what FRIA is all about.
Thank you. Francis, care to comment? And then I have a quick question in our Q&A box for you.
Yeah, FRIA was really envisioned as a pain-sharing mechanism, no, for the long-term good of both the debtor and its creditors. Okay, so there's I call it short-term sacrifice for long-term gain. Okay, now I think I started this presentation by defining what rehabilitation really is. No? A debtor cannot just go to rehabilitation for the sake of going to rehabilitation. It must show that its continuance in business is economically feasible and its creditors will be better off by rehabilitating the company than by the company going into liquidation. Okay, because as Dean Villanueva and Ida said, where will the bank source its business if all its let's say during this pandemic, it's all its borrowers get dead, di ba? So yeah, there will be pain sharing, short-term sacrifices, and hopefully everything will go back to normal. I think that's what the FRIA was envisioned to do. And as I said, the FRIA is grounded on the belief that businesses are the engines of the economy. And we have seen that, no? With the pandemic, a lot of businesses have closed down, the country as a whole, the economy as a whole is suffering. And I think that's anecdotal, no? For statutes like this. No? It's really for the long term. I think both the debtor and the creditor and its creditor should look at things not in the short term, but from the medium term to the long term. Mitch.
All right. Thank you. We have a question at the Q&A box. Does the FRIA law cover the roles of the so-called distressed asset fund industry? Francis, I think this is
Okay.
directed to you.
There are distressed funds that buy distressed assets in the hope that the distressed company will recover, and when that happens, they will have an upside. Okay. In fact, in some of the international conferences that I've attended, there are distressed debt buyers actually, and of course, the FRIA will protect the distressed asset buyer to the extent that it protects the original debtor, creditor, or even the debtor for whom they bought that distressed asset. In fact, in one of the seminars on the FRIA sponsored by the Shareholders Association of the Philippines, I think years ago, one of the speakers there was somebody from the distressed fund industry. And he said that they really have availed of the FRIA because there, as Cesar said, there's one thing that FRIA did was to create some certainty, no? And in terms of addressing the distress situation of the company, and of course that invariably affected the creditors. And the speaker was saying, if I recall it correctly, that there are some opportunities here, and we're glad that there is this law that provided a framework. So we in the distress industry exactly knew where we're going into.
All right.
May I
Yes,
chime in?
Ida?
Yeah, may I chime in on that? Because I'm a distressed asset company. Opal is an SPV, and we purchase distressed assets. With the concept of the FRIA and the SPV, there's a new law called feast. So basically, companies, buyers, distressed asset buyers can now purchase non-performing assets from banks. So in the question on FRIA assisting, helping, well, in the first place, it's two separate laws. And if you actually buy distressed assets and one of the distressed assets happens to be a loan under rehabilitation, whoever is purchasing, you need to respect. So you're just changing the hat from the bank to yourself. But one good thing about in the distressed assets, when you're purchasing it, because you've normally purchased it at a percentage discount, then it's something that you can now try to hopefully negotiate out of court. And I would like to say that in our case, we've been quite successful doing a lot of out of court negotiation and pre-negotiation, and it's within the FRIA law.
All right. That was my question for you. You answered it in advance.
Okay, sorry.
Yes, this one is for Cesar. No, there was mention earlier during the presentations that it's best for a debtor to coordinate, to communicate closely with his bank or lender, right? But there are situations, or there may situations be where, yeah, you want to communicate with your lender, but all you're faced with are lawyers, the legal department. You can't even uh, talk to your account officer, the one who sold you the loan years ago. What is a debtor to do in those situations?
Well, when it comes to companies that are classified as big borrowers, they always have what you call a red carpet to the bankers themselves, not just the lawyers or the bankers. Of course, the lawyers will always be there by the side of the bankers, but to them, it always makes sense to talk with their bankers, right? It always makes sense because together, the banker they would try to find a solution. In fact, when the loan is when somebody owes the bank a million pesos, then that borrower has a great problem. But when a company owes the bank several millions of pesos, it's the bank that actually has a problem. So they work it out. But more often than not, this is not available to the small guys, to the small companies. They will be met by the lawyers or by the managers who cannot really make decisions, right? So what happens at that point? They're really at the mercy of the banks, because all that they get, the bank managers whom they deal with, all they get are policies coming from the top saying that you must collect, you must ask for more collaterals and things like this, right? And they tag along. And since small businesses do not really have the capacity, hindi mahabang PC, in all probability, by the time they're talking to their banks, in all probability, no matter how viable their model is, they will not have the capacity to survive a financial distress. And all that they're talking with the bank, the talking that they do with the bank is really trying to prevent the inevitable from happening. That company will be closed down. And seeing that, most bankers just realize before this happens, let's try to get more collaterals. Give him 2 more months. Give us more collaterals, and then at the end of 2 months, they have a better collateral. It's not job threatening. So what do you do at this point? Therefore, it is what Ida has said. Businessman must really look at, do a health check and find the reality, do a model. If it is still possible, then do so. And if they can work that out with the bank, then they do so. But if they know that there's no possibility other than dreaming of being given a second chance at no business plan available, they might as well just protect what's left of their assets, family assets, right? That's what I say.
Francis, comments?
Well,
Debtors, yeah.
I think there's a changing view among the banks, no, that just as they help their big creditors, I think there's now a realization that the small creditors are also important, because without helping the small creditors who has a role in the supply chain, okay, their big creditors will also suffer. We have seen that even the big conglomerates have taken care of their MSMEs because these MSMEs are essential part, of their businesses. Without the MSMEs support, of their main businesses, then the big conglomerates also suffer as a result. But I think and there are banks that are trying to address MSMEs loans now. I think in one of the recent meetings, summits of the Shareholders Association of the Philippines, or Dean Cesar and I are active. No less than JASA of the Ayala Group said that he's talking to President Bong Consing of the BPI to see what can be done insofar as helping the SMEs is concerned. So I thought that is one good thing that's coming out of this pandemic.
Yes, thank you. Ida, from your own experience, what would you recommend to SMEs who are only faced with lawyers with banks?
Okay, this time, of course, the creditor hat. Yeah, they're faced with lawyers because it's in the policy. I mean, it's going to be an audit exception if the account officer does not give it to the lawyers. But it doesn't mean that they cannot continue and they cannot provide a restructuring proposal. But more often than not, the error is the restructuring proposal. That's why we gave a little bit of a brief here, and I suggest you learn more about that so you can arrange that with your banks. Okay, so having said that, on the bank's point of view, you don't want the client going through the courts, especially ordinary courts. It kind of takes average of like 8 years to fight under the regional trial court, 5 years under the Court of Appeals, and maybe a couple of years under the Supreme. It's going to take you forever to fight with a client. And if I may, it appears the ones that I've handled anyway, the courts will lean towards poor borrowers versus big creditors. So your chances of winning, it's going to take a while. And so I think that, and Attorney Francis is correct, and of course, Attorney Cesar, mentioning that the banks are, we've learned from the past that you cannot be too hard, because we know that if it's going to go through the courts, it's going to take too long. And what we now need to do is parang ano yan eh, a person who's sick, so you got to give medicine for that person to get up. And that's how the banks are looking at it now, especially it's pandemic. So it's a lot of them, we're doing okay, and they're VIP clients, and now this. So trying to find a solution for this. But of course, on the bank's point of view, if you have a lot of these clients, and it's good that with our present administration, the part of the exit of the banks is actually under the revamped law of FIST, Financial Institution Strategic Transfer, which now they are allowed to also sell their portfolio, the non-performing loans, so they can liquefy as well. So I think that becomes a win-win situation for all.
All right.
Mitch, if I
Yes,
can,
Francis.
okay, there's this the chilling effect on the banks of this FRIA in the event that they just ignore their small creditors, because all that the creditor, their small debtors, no, because all that the debtor needs to do is to file a FRIA, is to file a petition for rehabilitation. If that particular debtor believes that it can restore itself to successful, if its continuance in operation is economically feasible, and that particular creditor can recover more by way of rehabilitating the company than by way of liquidation. No? And if the debtor, that small creditor, as MSME, would go to court, that will really delay the collection process of the bank, because there is this stay order where pending the rehabilitation case, the bank cannot enforce its claims until that particular debtor is given a chance to prove that it can have itself rehabilitated, for example, by the entry of a new investor, by selling off some of the assets, no, liquefying some of the assets. And if the court sees that there is a substantial likelihood that that debtor can be rehabilitated, then the court will just give due course and eventually grant the petition for rehabilitation. So I think that's all the top in the minds of the bank lawyers, that if we don't treat this debtor the way we should treat our bigger debtors, then we can find ourselves in court too. So, and I think they're responsible enough, Mitch.
Thank you. Let's shift gears a bit. We've been talking about restructuring. Let's talk about the role of the board. What is the proper role of the board of directors in a company that is in distress, going into rehabilitation? I would like to ask Cesar first to comment on this.
It's always the board of directors of every company that is central to these things. All the studies that have to be done, all the options that are available, evaluation of whether indeed going to FRIA is something that should be done, or going to insolvency. These are all resolved at the level of the board, advised by their financial advisors and legal counsel, right? So that's where it is. Nobody else in the company other than the board and management know where the company is and what direction it can go, right? You cannot expect it to come from the stockholders who are unaware of it. So it is always central. It goes without saying.
Ida?
Okay, I'm happy you actually gave that question. Well, first and foremost is even the board may need to be restructured. You're trying to change a lot of the systems and procedures need to be changed. I got into fintech and digital transformation simply because a lot of the companies that I'm rehabilitating needed to change, and sometimes the problem with the companies are at the board level. So not enough. It's not even not enough. There's none. So the diversity in the board is actually quite important. Having someone that at least digitally savvy and stuff like that, and would have an expectation of where you're going. And Attorney Hester said the change in strategy, that's very important. Second to that, the role of the committees. So if it's a big corporation and you have committees, especially the risk committee can try to anticipate what's going to happen next. I mean, it was fairly obvious as early as May that the Alfresco restaurant will survive quicker than the restaurants, the Kulob, no? So those things, they should have done something in between. So when the lockdowns open, they would have a better chance of survival. Again, it was obvious that you should have gone online. So those things, those are the direction is coming from the board. But what if the board is not looking into risk management? And I'm happy to say that the amendments under the revised court code mentioning about the risk management, apart from the governance, is part and parcel, of course, of the requirement in the board, as well as the Insurance Commission revised code, as well as the Banco Central, as well as the SEC. So in all of this, there's a recognition that we need more in the board knowing how to do strategies and risk management.
Francis, your take on board governance for distressed firms?
Okay, again, this is one feature of the insolvency law that makes our FRIA distinct from other insolvency laws, because there are corporate governance principles, provisions in the law itself. For example, there is a provision in, I think, Section 10 of the law, which basically says that the members of the board of directors can be held accountable if knowing that if the company in which there are members of the board is about to go to rehabilitation, they agree to for example, the sale of the assets, giving of preferences to certain creditors, and so on and so forth. So that's very key. And I think there are special provisions governing the board of directors. The first challenge of a member of the board when the company is contemplating a rehabilitation setting, going to court for rehabilitation, is whether or not to approve the filing of the petition. Because as I said a while ago, it's not just a matter of filing a petition. The board, as a board, has to make sure that the filing of the petition is to the best interest of the company. Can the company present a feasible rehabilitation plan, especially in the light of the recent Supreme Court decisions, which basically says that a rehabilitation plan should contain what is called material financial commitments. Okay, for example, are the owners of the company willing to commit financial support to the company? If not, where is the financial support coming? And in one case, the Supreme Court has said that it's not just a matter of saying there are potential investors. You have to show that the potential investor is really coming in. Because if the board approves the filing of a rehabilitation plan, knowing that it is a sham, it is actually a sham rehabilitation, they can be made to account. Okay. For example, the filing of the petition may result in a cross-default petition, cross-default situation, or it can even engender the franchise of the company. Because I think in a franchise, then an act of bankruptcy, filing a petition, can take away the franchise of the company. If you were a director and you approve the filing of a petition, knowing that the petition has no clear chance of succeeding because there's no substantial likelihood of the company, then you can be held personally accountable as a director for having put to unnecessary risk, for example, the creditworthiness of your company, the franchise of your company, and so on and so forth. So, and there are provisions, as I said, which, for example, the board knows that the controlling shareholder is about to give a security to a creditor, to a particular bank creditor. And, no, and the board knows that the company is about to go to rehabilitation. The board should not approve that. If I were a director, I would object, because that is an undue preference, a fraudulent preference that is expressly prohibited by the law. No? So, and the law says that, for example, if and this has been an issue in the olden days, the controlling shareholder was siphoning off funds of the company because the company is about to go to rehabilitation. If there is a report before you as a director that the funds are being siphoned off to a foreign bank account, and that these financials are normally submitted to as part of the board materials, then you have to pay attention to that, because unconsciously you may be putting yourself in the person to risk as a director of the company. It's so important. Corporate governance is so important in a rehabilitation setting, Mitch.
Thank you. Ida, you mentioned earlier about debt restructuring. You also mentioned that maybe the board itself might be restructured. Could you expand on that, in the sense that what the debt restructuring really is an offshoot of restructuring the very business model of the corporation?
Yes, it could be. It could be. When you're talking about rehabilitation, people are concentrating on restructuring financials, the financial part, not necessarily restructuring the operations and management. And sometimes it's actually missing in the rehabilitation plan. Things need to be changed. If you doing things business as usual and the market conditions change, how do you survive? So that's why when I'm saying, even at the board level, I'm not necessarily saying you got to get rid of the board, but you can retool them, you can reskill them. So training at the board level should be adopted as well. Again, someone must look into the change in the market, must look at the risk management. That's risk management is huge these days. It includes what Attorney Francis mentioned in terms of knowing the laws, that you're trying to approve something and it's really against the law. And the next thing you know, that your rehab plan got trashed simply because of the form, simply because of the secretary certificate, or not knowing that you're not supposed to sell that asset, and you know that you're filing a rehab because so things like that. There's got to be some fairness into it and knowledge into it as well. I'd like to make a mention something, in terms of where the business is at. The mergers and acquisitions are very popular these days. In the past, those that are fighting may need to really combine because maybe the market has shrunk. So the decision again is at the board level, where pride should be looked into, because sometimes the collaboration may be the tool that can save you.
Cesar?
Miss
Yes, Francis.
No, I just want to amplify what I said a while ago. This is because a lot of members of MAP are serving as board members of the board of directors. I think if the personal liability of the director for doing acts that are expressly prohibited by the FRIA is double the value of the property that is concealed, for example, or sold or given as mortgage to preferred creditors, or double the value of the transaction. That's a very huge personal liability. So we may, as directors, we may be unconsciously putting ourselves at personal risk if we don't do our fiduciary duties to the corporation and just approve things that are presented to us for our approval only because we were appointed as directors by the controlling shareholder of the company. So that's very important.
Thank you. We have about 12 minutes left. I have one question for Cesar. At the beginning, we started about Senator Rocco's question about whose side are we on, no? And Cesar, you did mention that FRIA is really pro debtor, no? Could you expound on that, and why do you think that is so? And how can companies take advantage of that pro-debtor stance of FRIA?
The statement that says that FRIA is pro debtor is really should be looked at in the concept of leveling the bargaining terms between a debtor who really has no more weapons other than and facing the banks who on their hand have the formidable weapons, right? The fine prints of the contracts, the law itself, the enforceability of the loan and the mortgages, the ability to foreclose, those are all on the side of the bank, right? It's pro debtor because it just wants to make sure that the borrower has enough leverage coming from the courts, the stay order, to allow at equal end to bargain with the lenders, to be able to reason with them without a threat of being foreclosed. So that is what it means. It's pro debtor in the sense that it tries to equalize the bargaining stance between a giant of a lender versus the debtor who is now at the mercy, literally at the mercy of the lender.
Ida, your thoughts?
It is actually debtor debtor friendly. So actually, I lean towards that comment by experience. They can submit several rehabilitation plan, and you try to question that, and they continue to submit. Some of them are very trashy. For argument's sake, 10 years of no payment. Who in the world? Why would the creditors even agree to that? So I do agree that it's the debtor friendly, but there are provisions that are very reasonable. But if I may compare it though to the 902 and the 1909 insolvency, PD 902. So the laws prior to that were not good for the creditors at all. No, so the FRIA is a better law, and between going to an ordinary court and filing an injunction and fighting through that, we're given a little bit more leverage when it comes to the FRIA law. And as I said, that's preservation of assets, negotiation, and that sort of thing, cramming down on some of the unreasonable creditors that are with you. So yeah.
All right. We come to the last part. Perhaps we'll just go one more round from each of you, just to highlight some concluding thoughts or points, something you would like the listeners, especially the debtor side or the creditor side, some key takeaways that may make everyone be more open to burden sharing in this moment of difficulty. Francis, let's start with you.
Okay, we were lucky that long before this pandemic, we have put in place a modern version of a Financial Insolvency Act that was really envisioned, to operate in the worst of times. And I think so far this is the worst of times. So what I'd like our members to take to bear in mind is that if there's really a need for you to go to court to help yourself, your businesses recover, FRIA is there to help you. But you don't need really court approval for every rehabilitation or restructuring plans that you have, because under the FRIA there is the so-called out-of-court restructuring process, where court approval is not required for the validity of your restructuring agreement. All the court intervention under the out-of-court restructuring will only be available if either the debtor or the creditors fail to perform their respective obligations under the out-of-court restructuring. So it's there, and I hope that I really hope that you take a look at the availing of this auction in a worst case scenario. I know that your bankers are trying to help you, that the government is trying its best, that your suppliers, even your counterparties in the business sector are adopting a one-nation approach. But in the remote event that you need to real help, then there is this law that we can all take advantage of. That's my message for today, Mitch.
Thank you. Cesar?
We must recall that FRIA was enacted pursuant as a reaction to the Asian crisis, where foreign investors were really looking at the various jurisdictions in this part of the world and seeing an antiquated insolvency law. And they couldn't figure out how they would be protected in such modern times. So FRIA is actually a very modern legislation that has put the Philippine jurisdiction at par with world practice when it comes to investors looking at a modern system of rehabilitation and insolvency, right? And in fact, the author, Attorney Francis, was so crafty to even put provisions on cross-border provisions. That is addressed to, so the FRIA is addressed not only to the local businessmen, it's also addressed to foreign investors. And it makes the Philippines not looking like a 1906 jurisdiction, but a 2021 jurisdiction that investors can feel safe that there is a system that is modern and hard-looking.
Thank you. Ida?
Okay. I'm going to separate the borrowers and the creditors. Okay. For the borrowers, we need to be realistic. Where is the demand? Is there still a demand? That's the first question. Or will there be a demand after this pandemic, or when things so-called normalize? Now, if the answer is yes to the demand part, then you are probably restructurable. Please do know how to do it, how to do your rehabilitation plan, your restructuring plan. Do accept also the sharing of the pain concept, as you mentioned. Look at areas where you can sell down. It could be even your own company. It could be some of the assets. You know, for argument's sake, as a school, you can sell the school, that's an asset, but still operate the school and possibly request the bank to lease it back. So what you're trying to do is, at the moment, you cannot afford it, but in the future, you may be able to buy it back or buy a better school. So that time of sharing the pain should be, or should I say, cut losses, should be accepted by some of the borrowers. Now, for the creditor side, we are in a crisis, and when it comes to crisis situation, we need to look out of the box. So the typical restructuring, the ones that we have, we may need to evolve, because sometimes we need to see what's the debtors or creditors, I beg your pardon, borrowers' option. If their option is going to go to court, that would mean for us it may take time. So it's something that we may want to change some of the policies so it actually coincides with the present crisis situation. Thank you, Mitch.
Okay. Thank you. With that in mind, thank you, Ida. Thank you, Francis. Thank you, Cesar, for sharing your time, expertise, and most of all, your insights. Like many of our participants, I enjoyed this and learned a lot. Thank you, our attendees. Thank you, the MAP Governance Committee, and of course, the Secretariat, who makes us all look good behind these webinars. And so that's a wrap. Thank you. We would like to request our speakers and reactors to stay on for a short photo opportunity.
Yes, thank you,
Thank
Mitch. That
you
was
very much. Thank you
excellent
all. And
moderating. Thank you so much.
Thank you.
thank you. Thank you. And we will see you again in the next MEP events. Good day.
Stay
Okay,
safe, everyone.
Joanna,
Thank you.
take note.
Congratulations.
Thank you.
Please
Thank you,
include Mr.
Fred.
Fred.
Very, very interesting discussion.
Okay, ready? 1, 2, 3. Joanna, another shot. 1, 2, 3. Last one. 1, 2, 3. Thank you.
Thank
Thank
you.
Thank you. Thanks,
Thank you, Mitch.
Thank you.
everyone.
you.
Thank you,
Bye,
friend
friends.
Francis.
Thank you, Ses.
Cesar,
Thank you,
always a
Fred.
pleasure.
Yes.
Arnold and staff, thank you. Namimiss ko na kayo
Yes.
dyan.
Thank you.
Yes.
Arnold, pakita ka naman, oh.
Pinapakita yung mga
Yes,
ano,
yes, yes.
Baka ba-
the real power behind.
the power behind. Ha?
Yes, where?
Oh,
There,
Lalo
there.
bumabata
Oo.
si Arnold.
Ayan,
Hey,
picture
Beth.
ulit.
Milo. Maricel.
Si Beth is my Viber pal because siya yung kinukulit ko pag may tanong ako.
Hi.
I super
So, how are
enjoyed
you
that.
guys?
Thank you, Mitch. I knew. Galing talaga
And
mag-moderator.
thanks to Ida, she's my sponsor. she's my parang
Wag
ano ba
daw,
yun?
wag daw lawyer
Agent.
yung kunin na
That's right.
moderator.
You're also in charge of the CEO Academy, Mitch.
Si Vic yan, si Vic.
No,
Hindi pa nga siya MAP member,
No,
kinukulit
I will only submit
Members. Huh?
submit my application on Monday. I'm just
Yeah.
completing it.
Sponsor kami dito. Ang dami namin sponsor mo.
Sige. Sponsor na
Yes.
kami.
Okay, thank you.
Oh.
Bye, everybody, and have a nice
Alright.
weekend.
Eh,
Bye. Have a
Have a
good
great
weekend. Stay
Bye-bye.
safe.
Thank you.
Bye. Thank you, Ida.
Arnold,
Yes,
go na yung,
Francis, Fred.
yung MAP? Doon sa
Sorry?
statement? Sa statement, okay na kayo? Yung statement sa... yung
Ay.
statement on the...
Yes.
Oo.
Ako, I'll get back to you on the Fintech
Yes.
Alliance and Fintech PH. I'll get back to you on that one.
Oh, sige. Kasi baka
Sige.
alam mo, baka magka-point out ka agad eh.
Yeah,
Baka,
ang babata ng mga nominees. Ano ba yun?
Hindi, si Telly Bernabe will retire
Yeah.
March next year. Eh, yung dalawa, batang-bata. So, it's important na ano.
Yeah.
Oo.
Sige, sir. We'll
Sige,
do it.
okay, Arnold, thank you.
Okay, bye-bye.
Ilan ng
Thank you.
Okay. Thank you,
For
Arnold.
total participants, including Facebook. Thank you.
Oo. Sige, ingat kayo yan.
Sige. Okay. Thank you.
Thank you. Bye.